Hey, good morning, everybody. Welcome to another edition of the Monday Morning Playbook. For Beat the Bench, this is Scott Brown, and this is investment strategy for investment advisors. I'm here to get your week started off right, show you how you should be positioning client assets to outperform the benchmark, provide superior results over the course of your relationship with your clients, and continue to deliver those in a risk adjusted and risk aware manner. I'm so excited that all of you have joined us today. A special thank you to all the paid subscribers who signed up over the past week. We decided to basically, this is our first week that the paywall is going up. So if you want to read the deep dive tomorrow, if you want to read this full report, and if you want to read the individual equity report, stocks, the good, the bad, and the ugly, which will be out on Thursday. Going forward, you will need to be a paid subscriber, but I decided to make this video public, put it above the paywall in the report for one more week, just to give everybody a chance to see what this newsletter and this video series is really all about. So with that, let's get into it. First up here are some disclosures. Just want to show you real quickly that nothing here is intended to be advice for a specific purpose, for a specific, person. As for informational purposes only. Please contact an investment professional if you have questions about your own investments. The economic calendar, more opportunities for inflation hysteria, unfortunately. On Tuesday, we get durable goods and new home sales. On Wednesday, crude oil inventories, pending home sales. Thursday, initial jobless claims, and Friday, the Fed's preferred measure of inflation and everything that comes with it, all the PCE data, personal spending, personal income, all those things. Also, Chicago PMI, the Michigan sentiment, and the inflation expectations surveys all come out on Friday. And then you can see just almost every single day, there's multiple members of the FOMC board slated to speak. And so, obviously the market will be paying very, very close attention. We've had a huge ratchet up in what the market is expecting from the Fed. Basically, have gone from a terminal rate hovering at around 4% to 4.5% just in the past month or so. And really, the Fed has pushed back pretty strongly on the idea of cuts coming at some point next year. Again, just a month or so ago, the market was looking for a cut, or at least pricing in a small chance of a cut as early as March or so. That has been pushed back significantly. Our four key charts and graphics that we want to highlight. First, the beta barometer stands at 0.8. This means that we want to continue playing defense. We want to be underweight what we would consider the baseline asset allocation that your financial plan might spit out. There are times to be more aggressive, have more in equities relative to bonds, times to be a little bit more conservative. We're not at our max conservative, but we maintain it at 0.8, suggesting about 80% of the volatility profile you would target over a full life cycle with the client. Our balanced asset allocation does see one change this week. Now, we do not expect to see changes every single week. We are tactical, but we make changes when the charts require it. We had a small 5% sleeve to what we call diversified commodities that was sourced from stocks. Commodities did outperform stocks last week, so it did add alpha. But as we're about to show, the chart really is completely broken down. It just doesn't make sense to own commodities with a breakdown that we see in DBC, despite the relative strength it's showing versus stocks and bonds. We know how bad those have been. We just rather own cash right now and await better opportunities. Here's really the proxy that we use for diversified commodities, ticker DBC. You can see just a clear head and shoulders pattern, textbook bearish momentum divergence, but that breakdown that we got on Friday with about a 3.5% loss really completes this topping pattern to our eye. Again, it just doesn't make sense to be long this anymore, and it has been eliminated. Drilling under the surface of what really drove this, despite the fact that it is diversified commodities, about 60% of that ETF is in energy-related commodities. Crude oil is a big one in there. Brent's in there as well. But crude just completely broke down. It was kind of neutral in this range between about $86 and $94 a barrel. We took out a big level on Friday, and this just looks to have a clear downside bias for crude oil. Lastly, it's actually a separate allocation. It's a small part of DBC, but we consider it a separate potential allocation, a potential out of benchmark bet we would make in our balanced asset allocation. We can own gold if we believe that it, is opportune or could add value versus a 60-40 portfolio. However, that time is absolutely not right now. Last week completed the giant double top pattern that goes all the way back to the spring of 2020. This is just a major, major completed top. If we are below 1678 an ounce, gold frankly looks like a short, and we would not be surprised to see it run towards $1,400 an ounce. Our global equity allocation remains the same. We are 100% in US stocks. Nothing in foreign developed EFA, nothing in emerging markets. Those are obviously big bets versus the all country world index, but it just is what it is. As bad as the US is, emerging markets and foreign developed markets continue to be worse. Our sector allocation, as we are about to show, we remain underweight most of the growth sectors, including technology, consumer discretionary, and communication services. We are overweight utilities, staples, and industrials. I really think of this bet more as defensives over growth. And we're about to show the kind of pair trades, but if you are a type of investor that uses the major style boxes, and for you, it's really about value versus growth, this is clearly its value. All the things that we are overweight do fall into the value camp, and all the things that are underweight do mostly fall in to the growth camp. So it is value over growth, but I think of it much more as defensives. I wouldn't want to be incredibly cyclical here. If you just own a bunch of regional banks and things like that, it's not really too much better. A bunch of big banks or material stocks and things like that, those really don't look that much better. We'd still prefer them versus growth, but I think of it more about defense over growth as opposed to value over growth. Let's look at those pair trades. This is really key to our investing philosophy, is these ratio charts. Every time we're overweight something, it's coming from somewhere, and we really need to know what that chart looks like. We want it to look like an uptrend that we want to buy, a good looking stock. So here are those three pair trades that we basically have in the sector equity model. First up, it's overweight utilities, underweight technology. Here's the ratio of XLU to XLK. You can see it just broke out above the May and June highs. Clear uptrend, nice pause. Looks like there's more to go in this trade, and that's obviously not a great market message either. Staples versus discretionary. This is actually pulled back pretty sharply, and we've seen consumer discretionary outperform consumer staples since about May. That wasn't the case last week. Looks like this ratio was responding to a support at a rising 200-day moving average. You can see it actually acted as resistance some last year, so there's some extra credence to watching that 200-day moving average, but we continue to prefer staples to discretionary. Lastly, we mentioned industrials, maybe versus the S&P 500, kind of a neutral, slightly positive trend, but you pair it up with communication services, which is just exceptionally bad, and we're looking at a multi-year breakout and a clear uptrend. So we favor industrials over communication services and have that trade on in the sector model. Let's talk about the big picture, look at all the other charts and kind of supporting evidence for our generally defensive view. This is the chart of the S&P 500, bounced right, got to like 9 points away from 3636, which was the June lows on Friday. Got a good late day bounce. That's great. We're now oversold, but big picture, this is a downtrend. Looks like we're getting the retest, and frankly, the bull case now is it's just a retest and not something more ominous. But we have resistance just above at 3,900, and given the clear downtrend, just take a step back. This is not a good chart. This is a downtrend, and we want to play defense in downtrends. Critical to our call, something I've talked a lot about, is I've generally been of the mind that 3636 is likely in the ballpark of the ultimate low. Doesn't mean it's going to exactly hold, because what we see over history is typically a retest often takes out that low in price, but we see bullish momentum divergences under the surface. We kind of saw this in June. We're looking at the NASDAQ here. If you look right here, even though the NASDAQ went on to make new lows in June, less stocks made 52-week lows. The peak was actually back here. We're starting to see this rise, though, and we actually took out the June level and this is the highest level since the May high watermark of about 33% of NASDAQ composite stocks making 52-week lows. This is really important because not only do we want to generally hold the lows here and see that NASDAQ start to turn around, maybe late Friday was a good attempt, but if we get more than 34% of the NASDAQ making new 52-week lows, kind of resets the clock. And suddenly that becomes the new in the ballpark, or where are we at if that happens. For now, this is still intact, but something we want to watch and not a good trend that we've seen over the past 2 weeks with more NASDAQ stocks starting to make new 52-week lows. Just kind of showing that on something you can watch if you're not watching the internal data, but you want to kind of see what's going on throughout the week. You can look at ARKK. I think it's a big reason why we saw this, the embodiment of these speculative growth stocks. ARKK didn't break down to new lows and actually bottomed all the way back in May. Now we're kind of heading back for another retest here. If this breaks 35, I think that probably sees more stocks making new lows. So we're getting close. Support is support until it isn't, but it's still a bad chart and still kind of guilty until proven innocent. So 35 key level for ARKK. Last, let's just flip this to the S&P 500. So far, we're still good. Now, we did see actually the most new lows peak in June, but now we're in a full-on retest here. We got up to about 30% of S&P 500 stocks making a 52-week low in September, but that's still less. We just want to see that stay less than the 45% in June. Talk about our underweight to fixed income. This is the chart of the 10-year Treasury yield. It has moved 100 basis points to the upside in the past 2 months, and that's the second time that it's done this so far this year. Breakout up above the June highs. Yes, we are getting extremely overbought there if you look at RSI 14 and multiple other measures. But the fact is we want to continue to avoid and underweight core bonds because the risk to rates continues to be to the upside. Other thing that's just a risk to everything is the dollar. Everybody's very aware of this, but the fact is that the dollar seems to be breaking things. It's kind of really causing problems across the globe for other central banks, for other economies. If you just look, what does it matter to you? Look down there on the bottom panel. That's the rolling 3-month correlation of the dollar to the S&P 500, and it has been firmly negative for the past 3 years. So if the dollar's going up, stocks are most likely having a hard time going up as well. And if you look at this chart, it just says dollar to 120 or until some kind of, the Fed has to intervene because dollar strength is starting to become a systematic problem. Look at some more indexes. The Dow closed at its lowest level since November of 2020. Again, nice intraday bounce late on Friday, but both on an intraday level and at a closing basis. We got to the lowest level since November 2020. Nothing positive to say about the chart of the Dow. And it's kind of interesting. This has been the relative leader of the major indexes, and it's the first one to go below the June lows. Also back to the June lows and a really key level, the Russell 2000. This is IWM. You just look at that multi-year breakout from 2018 to 2020. That's where we bounced exactly back in June. Now we're right back there. IWM has to stay up above 163 to about 160. Otherwise, small caps are in big trouble. Let's talk about small versus large. This is just a neutral trend. We got a great question. Can you look at the Morningstar style boxes? If you have questions, you have charts you want to see featured, especially if you're a paid subscriber, just drop it in the comments, and we're going to make that happen for you. This is IWM versus the S&P 500. If you look over the past year, there's no trend. We're right at this 200-day moving average that's starting to flatten out. I haven't made a new low since May. I just wouldn't be making a big bet versus my benchmark on small versus large. If you did want to try and make a bet between all the corners of the style boxes, obviously we talked about we're overweight large value versus large growth. To us, it's really about defense, but it's value over growth, and especially value over growth within small caps. There's a really extreme trade here. It actually looks like a good entry point to just get rid of any small growth relative to small value. We saw this play out in the last summer as well, but you got a big oversold bounce, but right at the 200-day moving average, it looks like we're rolling over. And the more this continues lower, the more you want to be just in small cap value if you've got to be in small caps at all. XLK is another chart that's at a key level like the Dow and the Russell 2000, 123. We closed Friday at 123.74, but that is the September of 2020 peak. It's the June lows, and when it's right back there, it simply has to hold on XLK. Finally, something to look at bullishly. There's not a lot. Obviously, last week was very, very rough. And when you're a trend follower and looking at the markets, price is generally going to follow those things. But here's one, I think, really positive message. Maybe it's just a positive message for the economy, but it could be good for stocks. This is high yield spreads. And we expect this to generally kind of move with equity markets. But if you look here, what we have a really big bullish momentum divergence. And by that, or a bullish divergence. And what I mean by that is if the S&P 500 is back at its lows, we would expect high yield spreads to be, back at their highs from June. Except high yield spreads are 100 basis points tighter. And that's a good thing. That's a positive message from the bond market. So just something to watch there. But suddenly the bond market, at least the more overall spectrum, is not as freaked out about the economy as it actually was in June. Everybody was talking about this late last week. The AAII survey came out for the week, and for just the 5th time ever in the weekly survey, more than 60% of those surveyed said that they were bearish. What are the stats on this? Well, it's basically happened 4 other times. They came in pairs, around the 1990 bottom and then around the 2009 bottom. Both times there was a signal that was early. In 90, it was early by about 6 weeks and by about 8%. In 2008, you got this reading late in 2008, and the market would go on to drop another 25% over 5 months before it bottomed again. And we actually got the signal within a couple of days of the market bottom, the 4th time that it happened in March of 2009. So it can be a little bit early, but 1 year later, every single time you've had this, you have been higher on stocks with an average return of 30%. I think what's really important, because again, that's such a small sample size. We know people say that they're scared. I think one thing that's really important is what are they actually doing with their money? You can look at things like ETF flows. You can look at the put to call ratio. There's a lot of different things. And I think for the most part, to me, they're saying people haven't really panicked and sold. Everybody says they're bearish, but you can see the quote there from Walter Deemer. It ain't when everybody turns bearish that's important. It's when they finish selling. And one way to kind of look at that wonky thing, but this is the short end of the VIX curve and what's the shape of it look like. Think about volatility. If you're paying up for protection, it should be more expensive to do so over a longer time horizon. So the 3-month contract should always be more expensive than the spot price. But what happens when everybody just rushes to buy protection today and they dive into those short-term contracts is that this curve inverts or flips positive. And this chart goes over the past 15 years, but you can see almost every major bottom you've seen this VIX curve invert significantly, at least to about the 5 mark, sometimes to about the 10 mark. We've barely inverted at all so far this year. The VIX is hanging out at like 29 on Friday, hasn't even gotten to 40 yet. But this curve, we haven't seen any type of a real inversion, and definitely not the type that you would typically see with a major market bottom. So something that's been absent from the lows and something we are watching to see. We got a few more for you. We are close to turning a corner on seasonals. This is actually one of the worst weeks still for the S&P 500. But once we get to early October, you really get to that major bottom, and suddenly seasonality becomes a huge tailwind as you enter the most bullish quarter of the year. Last one, crypto. This is Ethereum, but something I got talking with Patrick Dunwilla on the trend lines over headlines video that I got to do last week, and I'm about to show you that was crypto. And crypto, I know you're like, I'm a financial advisor, I'm not putting client assets in crypto, but just as terms of a signal, it really just acts like a NASDAQ stock. You look at the correlation from Ethereum to the S&P 500 in the bottom panel, it's very high. And that's important because we look at this and it looks like a major top. So one more thing that unfortunately goes into the bearish bucket for overall macro view. So just in summary, stay defensive, underweight core bonds, favor defensives over growth, but value over growth if you have to make that bet with mutual funds. Don't take a big swing on small versus large. And commodities, it looks like that trend has turned, so they really don't deserve a place in our portfolios anymore. There is the kind of promotional headline graphic for trend lines over headlines. That's out from the chart report, but it was a special guest on there. I'd encourage you to check that out. Here's some of the same things we're talking about today, but you can also check out their previous videos. There's really a who's who of some of the best technical strategists on the street that Patrick has interviewed over the past couple of weeks. People like Dan Russo, John Roque. So check those out. I was honored to be one of his guests on that show, and also subscribe to the chart report. It's the best daily recap from social media posts from top technicians every single day, just a really concise summary of what's been happening in the charts in the market. So be sure to subscribe to that. That is what we have for you this week. Again, thank you so much for listening. Thank you so much to our paid subscribers. We'll be back tomorrow with a deep dive for you. And again, Thursday with stocks, the good, the bad, and the ugly. We're going to look at all the most important stocks this week. Just look at the top 20 stocks in the S&P 500, tell you, where the support levels are, where resistance is, and, what are the stocks, if any, that you can own in this market. So stay tuned for that. And again, thank you for joining us this Monday morning. Everybody have a good rest of your week.